And hey, thank you everyone for joining. I know it's an awkward time of day. We usually do this at 7:30, so we can do it before the workday starts. But I really wanted to see how the trade responded to the report today before really talking about it, because I think the setup that we have is really important, and I think we're on the verge of making some pretty big moves. So I'm going to jump right into it, and we're going to start with looking at exactly what the USDA is doing with the balance sheet. Okay, so first of all, for those of you that have not seen this, we have each of the prior reports listed over here, and this is just copied straight from the USDA's reports. The only thing that's really different is that we just consolidate all the use numbers into one number instead of breaking it down like exports and ethanol and feed and residual and stuff. We just think it's easiest to look at one number. And then over here we give some variables, so we can manipulate the yield and demand numbers, and we can see what's happening with the carryout. And as we all know, the carryout is the number that matters. The bigger this number, the lower the prices should go, and the higher this number, the bigger the number, the lower the price. The lower the number, the higher the price. So, and then ultimately we can look at this in a percentage form down here. And I think it's really interesting what the USDA is doing, because the trade is completely focused on yield and use, right? And you keep hearing chatter. If you're reading commentators, you keep hearing them talk about, oh, the USDA cuts are coming, demand destruction is upon us because the dollar is rallying and oil is super volatile. If people are driving less, so we're going to have less ethanol demand and all that stuff. So they're talking about it as if it's on its way, but the USDA's been ahead of this curve since June, right? They've been decreasing the carryout significantly. They've dropped it or decreasing use. They've dropped use 420 million bushels since the July report. That's a pretty fast drop. And if you'll notice, from August to September and September to October, they have actually slowed the rate of decay. So on this one, they dropped it less than they had in September. And I think that's significant because they also dropped beginning stocks. So the trade was looking for something a little bit smaller in a carryout, but the way corn traded today really isn't that bearish. And I don't know how many more demand cuts we're going to see coming from the USDA before they let more information out. And I know our exports are bad and all that stuff, but they've been telling us that's the case. They've already dropped it. So as we're looking forward, I'm wondering if we're not going to start pricing in a number closer to this one, because what happens if the yield slides? Well, let's keep the yield where it is, right? Let's just go 171.9. But let's say that the demand isn't that bad, and let's say it's let's add 150 million in. At this point we're under a billion. So the corn demand is anything but secure at this point, and it's not necessarily a foregone conclusion that we're going to just crash demand to zero and start to move this number higher and catch back up. I mean, the USDA has dropped the stocks to use by almost 2% in 3 months, and that's a really significant drop. So it's amazing that corn. This is our corn chart. It's amazing that we've held up as well as we have held up through this time period. So here's your July reports, right? Here's your August. Here's your September. And as the USDA has been cutting demand in each of these months, the market has actually priced in a higher level, a higher valuation than we had before. And I think that's really bullish. And the analysts say, well, it's because we're discounting lower yield. Well, now we know what they think the yield is with reasonable certainty, and yet we were unable to break this upward trend line today. Now, did we do anything emphatic? No, definitely not, right? We we barely closed at yesterday's close. We didn't take out the prior day's high. We didn't take out this little swing trend line that's been from this consolidation area for the last couple of weeks. So corn really didn't do anything emphatic, but it also didn't do anything emphatic to help the bears either. You know, if you were going to break this market, you want to see it definitively bust this trend line and come attack this these two lows right here almost immediately. I mean, if we're going to roll this thing over, we need to be below 660, you know, in a day or two, not 5, 6, or 7. We want it to be a straight drop. So I think that this interpretation, where we're looking at a fib retracement from this peak right here that traces all the way back down to 560, I think that that got damaged today. I don't think that this interpretation, this isn't how that interpretation would play out. We would roll over and we would implode. So I think corn is pretty simple from here, right? Anything above this $7 level, you got to be long, and anything below this trend line, you want to start selling it. And if you're new to listening to us, the more you do this, and the longer you're in this business, and the more you trade, the simpler you want things. I can show you stochastics and RSIs, and I can show you indicator after indicator. But the reality is that this thing's pretty obvious. This trend line's important, and if it starts to go, you've got layers of protection or layers of support here at 671 down to 661, and below that, Katie bar the door, I think we're headed all the way to 560. So really important price action in the next few days and weeks. Okay, that's corn. I hope that's clear enough. Anything above this trend line, we want to stay in it. We want to own it. Where are we? If you're asking, I've been advising people to sell all the way through this consolidation period to make sure hedges are in place, and that's what we have. But we also want some upside open just in case it does start to work higher. And if we do start to break lower, then we're going to start escalating hedges for the rest of this year and into next year as well. But we'll let price action be our guide, and we're not going to jump to any conclusions there. Okay, so now let's look at soybeans. Soybeans are even more complicated, in my opinion, because the USDA has had us at or below pipeline, for months. And they've also decreased demand by 178 million bushels since the June report. So just like corn, the USDA has been telling us that they're decreasing demand as the dollar has rallied and as oil has ticked lower. They've been telling us this, and so the market has been trying to sell off, but this number is just too tight. 200 million bushels at 4.5% stocks to use is too tight to have an extreme downward move. So when we're looking at soybeans, come on, computer. All right, so let's set this up for you so you can see exactly what it is we've been looking at. Okay, big picture from the summer highs, we've got this wedge formation that's been tracing. We finally broke out of it on this big September 30 stocks report where they raised the stocks and oh my gosh, we have too many. We have this corrective price channel, and the way you draw that, right, from this peak to this peak, then you just snap a parallel line to the intermittent to the swing low in between them. And once you fall below that, we should have just accelerated this thing lower all the way down to this magnet line, and really all the way down to $12, which is what we have been looking for. But today's action is pretty significant because what have we done? We've chopped right back inside this corrective price channel, and we've done it in a 1-2 sequence. So today's low, and for sure yesterday's low, become critically important because if we break back down below it, we've broken back down out of the corrective price channel, and we've left behind a 3-wave move, which would reinvalidate that case. But as we stand today, I think you got to look for pressure to be put up here on this 1429.30 area, which is all this compression, which is the bottom side of this trend line from the summer. and we'll see how it trades when it gets there. If the market thinks it needs to put premium in because of increased demand, because the dollar breaks, or because dryness in South America, then it'll do it, and it'll first have to break through this stuff. So no reason to get out ahead of ourselves and jump in and go crazy for it. But I do think the upside looks a lot better today than it did even yesterday, because we're back inside this. Now, let's go out and let's look at March beans, because they're starting to become more highly traded, and they've actually have held up better than the December or than the November contract. Okay, if you look at November, we have traded below all of these lows, but March has never bought into it. And it makes sense if you think about it in context of that carryout, right? That carryout is still very near pipeline levels. So the futures market is refusing to break out in time because it knows it's got to hold the values up in order to preserve supply. So this makes a lot of sense when you look at it from that perspective. So March beans are much easier to trade than November's, because we're already above this shelf of support. And so you want to hold a long position anywhere above this 1379 area. Maybe if you can even take it all the way down to the absolute swing low. But I like to look at the where all the opens and closes are, which is in this range right in here from 1379 to call it 1390, which we held, and now we've rallied back up into it. So next area is the 1439, 1420, 1425 to 1439. And if we can get back above this peak, which was the September 30 stocks report day, we can get back up above that, then I think you really gotta look to put pressure up onto the top of this range. And who knows what the fundamentals will be when they get there, because and we've talked about this for weeks and weeks and weeks. It makes no sense that the dollar can rally like 18% and oil can implode by 35% and the grains hold where they're at. That really doesn't make any sense, because that should be way more demand destruction than what we're seeing. And the USDA is just not really confirming that that's all there, even though they have trimmed it some. So we may have more to go here, and the next few days is going to be really important to see how the traders digest it. If we come in tomorrow and we just kill it and we take all this stuff out, then hey, we're going to rally our bearish drums again and reset hedges and get moved to the short side. But as it is, I think we gotta look up for the next day or two. Now, wheat is the tougher one. As far as wheat goes, you had this 4-day consolidation period. You broke it, then you immediately rallied back into it Monday night, took the whole thing out, and now we're right back at the bottom. We're on the bottom end of this trend channel. And wheat probably has the most bullish fundamentals, right? If you just look at the ending stocks, I mean, we're really tight. But what's killing wheat are three things. One, it's the talk that the corridor and that the bushels from Russia are going to continue to flow. You've got threats that Russia is going to drop its export duties and just try to flood the market with cheap wheat. You've got the dollar pressuring our exports. And then third, you've got talk of increased acreage here, even though we're in a drought. If we do start planting lots more acres because of fertilizer availability or because of just input cost and guys wanting to plant more, then the market might start to discount that, especially if it starts to rain. So how do we approach wheat, and what do we do with it from here? We're hedged. I think it's appropriate to be hedged. I don't see anything in here that would say that we need to lift those hedges unless we trade back above and break the top of this trend line. If corn rallies and beans rally, I think it's hard to break wheat much from this level. And if we do, we may break it and then rally it right on back up through. So we're going to be really patient, give it lots of room, and try to make sure that that we don't let good values near this $10 level escape us because we're trying to overbet on the long side. These markets are this wheat market is incredibly volatile. It's extremely difficult to trade because it doesn't seem to move with any order. If you drill down into wheat and look at it on a 5, 10, 15-minute time frame, it moves in dimes, not in pennies or ticks. Corn and beans tend to move in quarter cent increments with pretty much smooth trading action. Wheat is not doing that at all. It's moving in nickels and dimes, making it very difficult to get prices filled. So I think you got to stay in your hedges for sure below this shelf right back in here, back behind this swing high, and probably even below this upper trend line. I think we really wanted to break it decisively and start to move higher before we jumped in and started buying it again. And I know that's painful for some of you because you really want to get back long wheat because you feel like it's running away. All right, a couple of the outside markets here that we want to look at to keep things in context, right? So the USDA has trimmed corn and beans from the June report forward into this dollar rally. So everyone that's saying, oh my gosh, we have to break because they're going to hurt demand, the USDA already did it. They've already priced this in. So I don't know that this dollar move really carries much weight anymore with all of them. And I wonder what's going to happen if the dollar were to roll back over here and come back down and test this 108 level or whatever. It's just food for thought. We're not going to trade commodity our grains off of the dollar necessarily, but we want to be realistic. And anybody that says the dollar's too high, we have to crash, I don't think so. I mean, this is old news. Tell us something we don't know, right? Now let's look at oil. Oil and corn have about an 80+% correlation, and yet we have rallied corn all the way through this decline in oil. And we didn't really rally corn through the last 2 weeks, but that's because we did it for the last several months into the demand cuts from the dollar and from ethanol. Read a thing earlier this week that every percentage of decline for U.S. gasoline usage is 50 million bushels of corn. And that would equate to, at a 6%, right, that equates to 300 million bushels of corn. Well, the USDA is not really reflecting that. So something is going on here in the corn market to make it stronger than oil. And that's either because oil is about to rally and demand is really stronger than we think it is, or it's because our supply is really just so tight we don't have any room to give. So don't pay attention to the headlines that you read throughout the day, and don't look at oil and think, oh my gosh, corn's got to do the same thing, because it really doesn't, and it hasn't for months, because we put a lot of premium on corn that wasn't there on oil in the first place. Okay, so conclusion here real quick. Corn, let's review it really quick. Corn, anything above 694 is super bullish. I'm bullish. Anything above, really above today's low at 680. I want to see that get broken out. And I think we got to look higher, probably up to the 730 area. Got to go fill this gap. And if we do get up here, we'll see how it unfolds and how much exuberance we get and what the news flow is when we get up there to see if we can't push it higher. But we'll let price make that decision for us. We won't try to overthink it. Soybeans, same thing. I don't see corn rallying and beans imploding. We talked about that yesterday. I think that ratio's got to stay together. And if corn goes higher, beans got to go with it. And they had the most bullish report and the tightest stocks to use. So I wouldn't be surprised to see them start to work higher. Wheat, we're going to take our key a day at a time with wheat, hold our hedges, and look to reown it if we do need to on a higher breakout. All right, that's 21 minutes. For those of you that are listening for the first time to this, we do this every Wednesday morning usually. We spend 20 minutes, and then we try to update you throughout the week as necessary and as things develop. If you have any questions, you can always email us and ask us. We're happy to jump on a call with you to talk through it. As always, there is risk trading commodity futures and options. And if you're going to trade them, you've got to do it in light of your own financial condition, and you got to be responsible for the decisions that you make. And if you need help with those, we're more than happy to help with that as well. I hope you find that somewhat informative. If you have questions, reach out and call us. We will talk to you next Wednesday.